I'm Nate White, and this is Dave Young, and we're with Paragon Wealth Management. And right now we're discussing active versus passive investing. And Dave, maybe we should explain what does that mean? We're more active investors here at Paragon, but what does it mean, active versus passive investing?
Well, passive is just more your classic buy and hold that most of the big institutions use, where you essentially take positions in different asset classes and you just hold those positions and you just ride with those positions over time, with the idea that over time, markets generally move up and you can get your returns that way. Active is a lot more as the markets go up and down and fluctuate. You're trying to capitalize on those movements, and also as different asset classes move. So as, say, small caps are moving, but large caps and mid caps are not. You're trying to capitalize on that asset class that's moving.
Okay. What's maybe doing the best right now, would you say?
Well, I'd say for about the last year and a half, your passive strategies have worked the best.
Right.
And it's interesting as you look over time. It does switch back and forth, and it really depends on the effectiveness of the active manager. For example, over the last year, we've underperformed here at Paragon using an active strategy. But if you look at 3 years, 5 years, 7 years, 10 years, and our since inception numbers, we've outperformed during all those time periods. So, and along over that 13 years, there have been several periods where passive has outperformed active, but generally we're able to make it up and surpass the passive.
In volatile markets, a lot of times those passive strategies will tend to outperform sometimes, but not always. Because I know those active strategies give you that flexibility that you can make a call that when the markets are oversold, you could go in and buy, or maybe on the opposite side. What are some of maybe the disadvantages of an active strategy, and then how do we try to deal with that here at Paragon?
Yeah, well, the disadvantages are pretty apparent that have been happening recently. If you look at the last couple months, we've had major swings in the markets. I mean, back in July we sold off 2,000 points, then we rallied back 1,000, then we sold off 1,000, then we rallied back 1,000, sold off 1,000. When you get this extreme back and forth movement, right, if you're active and you're trying to adjust to that, that's usually going to hurt you, because that's the market action that doesn't normally occur, right, on an extended basis. Normally you'd have 1 or 2 of those moves. We've had 8 of those moves in the last 2 months. So if you make any adjustments to your portfolio to capitalize on those moves, they move so fast that that's going to hurt you normally. Whereas in this scenario, passive strategy would just go through it. Right. Now the problem is you don't know in advance which way it's all going to work out. Right. And so, for example, going back to July when the market sold down, if the market was sold down those first 2,000 points, an active manager makes his adjustments, and then the market continues to fall, well, in that situation, the active manager is a genius, whereas the passive manager looks like an idiot. So it really depends on the market circumstances and the tone and the fluctuations that are occurring within the market.
It generally seems like most people will go to whatever strategies work the best in the most recent time period. So if passive works best, everybody goes into that, probably at the wrong time, and then it underperforms, and everybody goes to active strategies, and they kind of, the yin and the yang through each other at that time. But one thing too with the volatility also creates a lot of opportunity, especially short term, because the markets get dislocated in the short term, creates a lot of opportunities. And I think an active manager can go in and take advantage of those, whereas a passive person, they're not going to be able to go in there and take advantage of that because they're not watching what's going on at the time and taking advantage of opportunities that present themselves.
Right. No, I just see a passive management strategy as basically just giving up and saying, right, I have no idea what's going to happen, so I'm just going to let it go, and whatever happens, happens. Whereas an active manager, in my mind, at least you have a fighting chance that you're trying to adjust and capitalize on what's going on. I think the other, besides the volatility, the other issue that's been hurting active managers lately is the correlations between the asset classes. Normally there's a much bigger separation of asset classes. When you look at all the different categories, they act differently, and some are going up, some are going down, some are going sideways. But the last year and a half, those asset classes have all been moving together.
Right.
And so that's another thing that makes it harder for an active manager. So those two things are really, the volatility and the correlations are both things that make it more difficult for an active manager. Once you get trends that last for a while, then you can capitalize that, and that's when an active manager will usually outperform.
Right, with the trends.
Right.
Okay.